begin today's journey. Right. So here we are on our MCQ questions. Here we are on our MCQ questions. Rachita, will you be in the position to take screenshots today or should I take?
Yes, I will take.
You'll take it, na? Chal, good. Let's take a look at, let's go from last two first. Why? What happens now? Last questions फिर रह जाते हैं. I don't want that to happen. All right. So let us see. Screen visible? Everybody able to hear me? Shall we
Yes, sir.
begin?
Yes,
Okay.
sir. Yes.
Question number 54. Question number 54. MCQ number 12718. What will happen to the quick ratio if a company collected outstanding receivables and sold the short-term marketable securities? I'm sure you all can answer this based on yesterday, but let us do the discussion. Now they are asking you what will happen to the quick ratio. Quick ratio will consider quick assets. Quick assets are cash, accounts receivable, शॉर्ट टर्म मार्केटेबल सिक्योरिटी जिसको मैं STMS ऐसा शॉर्ट फॉर्म लिखता हूं, एंड ऑफ कोर्स देयर इज अकाउंट्स रिसीवेबल, बट हियर अकाउंट्स रिसीवेबल इज नॉट देयर, इट इज नॉट एप्लीकेबल फॉर दिस क्वेश्चन. नाउ पे अटेंशन. Now suppose if I say that my cash is 100, my accounts receivable are 40 and my STMS are 20, which makes my total quick assets 140 plus 20, 160. And let me say that my current liabilities are also 160. So what is my quick ratio? My quick ratio is 1:1. Now what is happening? Everything is becoming into cash. So now cash, accounts receivable is converted to cash, STMS are converted to cash. So my cash will now become 100 plus 40 plus 20 upon 160, which keeps my quick ratio, new one, also 160 by 160, which is 1:1. You will say that this is a very easy question. Why did I waste my time on this question? No. The important concept to be discussed over here is when a quick asset converts itself to another quick asset and current liabilities are unchanged. Is this the scenario that you are facing in this question? One quick asset has become another quick asset and current liabilities are unchanged. Is this your scenario? In this scenario, quick ratio is unchanged. Agreed or disagreed? But when a quick asset converts itself to a non-quick asset and current liabilities are unchanged, then quick ratio will fall. Do you agree with my statement? Think about it based on yesterday's clarification that I have given to you, my dear students. Based on yesterday's clarification, please think about it. I want responses. Yes or no, please tell me that. Yes or
Yes,
no,
sir.
please tell me
Yes,
that.
sir.
Suppose I am buying inventory by using cash. So cash has reduced, but inventory will not factor into the formula of quick assets. So what will happen because of that? Because of that, obviously, my quick ratio will fall. Now suppose, take a opposite case. When a non-quick asset, suppose inventory converts itself to cash and current liabilities are unchanged, what will happen? Your quick ratio will increase. Why? Because your existing level of cash, because your existing level of cash, which is a quick asset, will increase. क्वेश्चन पिद्दू सा है, इसके बारे में कोई डाउट ही नहीं है. इट्स अ वेरी वेरी चाइल्डिश क्वेश्चन, बट द कॉन्सेप्ट is a good one. So when you revise this question, The question you may read, but these three concept notes, 1, 2, and 3 are very, very important for you. I hope everybody agrees with all the statements that have been written down over here. Yes or no? Kindly give me a thumbs up. Albas, I believe you will not understand this because you have not yet watched the recordings. Be a mute spectator. Try your best to gather whatever is there. You will get the data today. Don't worry about it. Once you get the data dump, you will have time to watch it. Comfortably watch everything. It will help you out. Just be patient. Okay.
I'm able to understand.
Everybody else, are you understanding whatever is being discussed? Yes. Sakshi, Rachita. Rachita may not. I'm not sure. I'm assuming she may little bit. But Sakshi, Monica, Khushi, Preeti, Danish, Aditya, Lokesh, Haripriya, Nashla, and Alok also might not. So the guys who are attending today with continuity of yesterday, I believe you have understood. Give me a thumbs up. Can I go ahead?
Yes, sir.
Okay. Rachita, please will you take a screenshot? Taken? Okay. So over here, your answer will be quick ratio is unchanged. Here your answer is quick ratio will be unchanged. So you can go for this screenshot now because the answer is highlighted over here. Everything else does not make sense. Quick ratio. Now 1 second. Let us also add some comments. Quick ratio will dot decrease. No, because quick assets are not reducing over here. This is a concept point. Quick ratio will increase. No, because quick assets are not increasing. They are just becoming quick assets. Quick asset becoming quick asset. Current ratio would be unchanged. Yes. Unable to determine, not applicable. You will be able to determine. Therefore, your answer is going to be point number C. I hope this is clear and conceptually sound for everybody. Rachita, now please take a screenshot. Now you've done justice to the question. Yes, can I rub it? Okay. Let's go to the next question. Question number 53. Now, question number 53, I have put a, what is that? A flag on this question. Now, let's read the question and then we have to do conceptual revision. At the beginning of the year, the company reported total assets of 50 million and total stockholders equity of 34 million. Fair enough. At the end of the year, the company reported total assets of 55 million. Okay. And stockholders equity of 44 million. What is the company's debt to asset ratio at the end of the year? No problem. So now from our liquidity ratios, we are going into leverage ratios. Let us understand number one, something known as, this is a conceptual recap. This is a conceptual recap for all. First of all, let us understand the balance sheet. When we make the balance sheet, there is something known as balance sheet equation. What is balance sheet equation? This is the asset side. I will call this big A. These assets comprise of non-current assets, which are your property, plant and equipment, meaning nothing but your fixed assets, your non-current investments, your intangible assets, and goodwill. Right? It also comprises of current assets, which are cash, which are inventory. I'm purposely listing it down, which are accounts receivable, notes receivable, which are you can have prepaid expenses, etc. Now the liability side is not only liability side, it is equity plus liabilities. It comprises of equity and liabilities. Now liabilities are of two types. Liabilities are of two types. The first are your non-current liabilities. In non-current liabilities, what do I have? I have long-term debt. Long-term debt have an attached cost to it. Can anybody tell me what is that? They have an attached cost to it. Can anybody tell me what is that? Interest is the right answer. Meaning अगर आप लोन लेते हो आपको उस पे ब्याज देना पड़ेगा. Have an attached cost of interest to it. Do you all agree with my statement that interest is a fixed charge? Yes or no? Please tell me that.
Yes, sir.
If it is a fixed charge, I can also call it as a fixed financial expense. Yes or no? Please tell me that. Whenever there is a fixed expense, there exists a risk. What there exists? There exists a risk. This risk, because it is owing to fixed financial charge, this risk is called as degree of financial leverage. What is this called? This is called as degree of financial leverage. Does everybody agree with my statement? Yes or no? Please tell me that. What is this called? This is called degree of financial leverage. Understanding everybody? Yes or no? Now, let's go to liabilities. Liabilities, one is non-current liabilities. Yes, provision comes under current liabilities. Don't worry about it. Then comes your current liabilities. What are your current liabilities? Accounts payable, notes payable, outstanding expenses, etc. Please understand that your current liabilities are always assumed to be operational in nature. What is the meaning of this? They are related to business and not financing. What is the meaning of operational in nature? They are related to business operations and not financing element. So current liabilities do not contribute to financial leverage. Am I clear about this, ladies and gentlemen? Current liabilities do not contribute to financial leverage. Am I clear about this? Yes or no? Please tell me that. They are what you do for business. You take goods on credit, you give somebody payment next month, so on and so forth. They are not connected to your sources of finance. They are connected only to your operations. Current liabilities are not a source of financing, not a source of financing. They are related to only and only the business operations. Are we clear about this? Yes or no? Please tell me that. Are we clear about this?
बैंक ओडी करंट लायबिलिटी में बट उसमें
Bank
इंटरेस्ट
OD, what happens with bank OD is bank OD can be considered to be non-current also. Because if you take a huge amount of an OD, it is possible that you are paying it over a 3-year period. Secondly, bank OD is used for working capital purposes. It is not used for financing per se. So bank OD, although it is a source of funds, it is considered to be a working capital operational source of funds. From a bank OD, you are supposed to generally, pay off your creditors. You're supposed to generally meet your expenses, but you're not going to create assets out of it. Like you would create up from debentures that you would create from bonds. Why? Because a bank overdraft is unsecured. It is a credit the bank gives you for being a businessman. Chalo, Monica is a businesswoman with our bank of Kotak Mahindra. She has got a account balance that she maintains every month of 25 lakh rupees for her business purposes. Now, her monthly cash burn is suppose 75 lakh rupees. Now, in one particular month, she is able to meet 65 lakhs out of it, she requires 10 lakhs. The bank will give her like that only because the bank knows next month 25-30 lakhs is going to come. So what will bank do? It will give her a 1 year OD period of 10 lakh rupees and charge a 11% interest on it. Understood? Why do I say the term 11%? Generally, in the current financial market, OD's current market rate is 11%, 11 to 14%. It can go to 24% also, but that is poison. Are you understanding what I'm trying to say?
Yes, sir.
Right? So
Yes.
ODs are generally looked at as both a non-current as well as current. And IMA has been very, very smart. They have not asked you questions on bank OD anywhere, even in your exam support package or in your Baker, Sargent, what is that? Hawk, Gleim, Wiley. सब लोग उससे दूर छुप के बैठे. But we do this in CA day in and day out. We consider bank overdraft to be a non-quick current liability. Understood?
Okay, sir. Yes, sir.
Right? Okay.
Yes.
Now, so where was I? I was saying that long-term debt will have an attached cost of interest to it. Now, understand that a balance sheet will always tally. This XX will be equal to this XX. Therefore, can I say that total assets is equal to equity plus total debt. Now, total debt is a term that they are using in US. Total debt, my dear friends, is non-current liabilities and current liabilities. What is it? It is non-current liabilities and current liabilities. Therefore, can I say that total assets minus equity is equal to total debt? Yes, I am just taking this equation, taking one thing on the other side. Therefore, I can also say that total assets minus total debts is equal to equity. Agreed or disagreed? Agreed? Basic equations. Basic equations. We have to understand in this recap the impact of debt on your balance sheet, or rather on your income statement and balance sheet. We have to understand the impact of debt. Total debt, yes, 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 will have both non-current and current, as I have indicated in the diagram. Right? So, Rachita, can you take a screenshot of this much right now? Now, before I rub this, I would like to revise this concept thoroughly. Please pay keen attention to what I'm saying. Balance sheet is equal to assets and equity plus liabilities. Assets are current and non-current. Equity is always neither current nor non-current. Equity is equity, it is permanent. Liabilities, also referred to as total debts. Liabilities, also referred to as total debts, comprise of non-current liabilities, which are your long-term debts. What will you have over here? You can have over here bonds. You can have over here debentures. You can have over here long-term bank loans. Or you can have over here long-term sources of borrowing. Sir, what are long-term sources of borrowing other than this intercompany loans, NBFC loans, etc.? They can be anything. Generally, what will we get in the exam? You will get bonds, you will get debentures, and you will get long-term bank loans. This long-term source of borrowing will not come, but you need to know that a holding can give it subsidiary a long-term loan, subsidiary can give holding Falana Dimka. All of that can keep happening. All of that can keep happening. Now, current liabilities. Accounts payable, notes payable, outstanding expenses, etc. Both these guys put together is equal to this L, that is your liabilities. Liabilities, which is total debt, is equal plus equity is equal to total assets. This is called as balance sheet equation. What is this called? This is called as balance sheet equation. This is the first thing that they teach you in accounting in MBA finance, the balance sheet equation. Please keep this much in mind. This is called your balance sheet equation. Now, our objective is to go beyond an MBA in finance and understand the impact of debt on your balance sheet, right? Now, please take a screenshot of this. The next points that I'm going to write are equally important. Is it taken? Can I rub it?
Yes.
Any doubts that anybody has, please ask. Okay, now next. Now, this is what your balance sheet looks like. This is what your balance sheet looks like. Let's say your assets are 10 lakhs. Your equity is 4 lakhs. We'll write it in numbers. I don't want people to get confused. It's 10 lakhs. So we'll write equity is 4 lakhs. And let's write down debt is 6 lakhs. This is tallying on how much? 10 lakhs. Now, out of this debt, let me give you a bifurcation that non-current liabilities are bonds. Now, everywhere I will use the term bonds, debentures, bank loans interchangeably. Bonds, debentures, bank loans, whatever I say over here will mean the same thing because it will not have any impact. Please understand this concept. There are 5 lakhs. And your current liabilities are 1 lakh. Are how much? 1 lakh. Now, can I say in this case that you have financed 5 lakhs of your 10 lakh worth of assets from debt, that to non-current debt? Can I say this statement? See, your non-current debt of bonds is sitting here in this 6 lakhs, and these two are translating into your assets. So can I say that 50% of your assets are purchased from debt? Yes or no? Please tell me that. Yes or no?
Yes,
Please
sir.
tell me that. Does everybody understand this? Take a second
Yes,
to
sir.
assimilate it in your mind. Tell me, understood or no?
Yes, sir.
Everybody is understanding. Rachita, Khushi, then Preeti, Danish, apna Aditya, Lokesh, Haripriya, Nesla, Albas. Everybody is understanding this. It's very important. Yes or no? No. Therefore, can I say that you are financing 50% of your assets from borrowed funds, and on these borrowed funds you are paying an interest. Because of this there is a risk, and because of this there is a financial leverage. Agreed or disagreed? Please tell me that. Because of that there is a financial leverage. Why? Financial leverage is a measure of risk. This is risk of a financial nature. Does everybody agree with my statements? Yes or no? Please tell me. Come on, guys.
Yes,
Agreed or
sir.
disagreed? Agreed? Okay. Let's go ahead. This was your case A. Let's take a look at case B, the profiling of a company. In this case, see, this company has assets of 10 lakhs and they are all financed from equity of 10 lakhs. Surprising, in this case, there are no borrowings. There are no borrowings. There is no fixed interest payment. Agreed or disagreed? Yes. Therefore, there is no financial risk. Therefore, there is no financial leverage. Agreed or disagreed? Agreed or disagreed? Yes or no?
Agreed, sir.
Everybody says yes? Okay.
Yes, sir.
Yes.
Now, wherever there are borrowed funds, number one, company wants to know ratio of A, borrowed funds and total assets. Number B, borrowed funds and equity. Why? They want to have a proportion between outsiders and owners. Why do I use this word? My dear friends, equity are the owners of the company, whereas the providers are debt are outsiders. Do you agree with my statement that equity are the ultimate owners of the company and providers of debt are nothing but your outsiders? ये बात से आप सहमत हो? ये बात आप मानते हो कि इक्विटी कंपनी का मालिक होता है, असली हकदार कंपनी का कौन होता है? इक्विटी होता है। ये डेट वाले तो भैया उधार पे पैसे दिए हुए लोग हैं, just given you money on udhar, they are nothing but your outsiders. Agreed or disagreed? Please tell me that. Yes or no?
Yes,
Yes or no? Finally, they want these ratios that they come to know are your other leverage ratios. What are they? They are your other leverage ratios. Am I clear about this? What are they? They are your other leverage ratios. Now in the next slide, I will talk about these other leverage ratios. Are you with me on that? Yes or no? Please take a
yes,
screenshot. Please take a screenshot. Rachita, taken?
Yes, sir.
Now, go to the next slide. Now, pay attention.
So just a sec, go back. Done, sir.
I need to get a manicure. Joke of the day. Now, let's pay attention. There is a ratio called debt to assets. What is this ratio? Debt to assets. This ratio helps you understand what percentage of assets are financed by debts. Debts can be non-current liabilities and current liabilities. When I am calculating a percentage of assets, जिसका percentage ले रहा हूं वो हमेशा डिनोमिनेटर में आता है, करेक्ट? बेसिक मैथमेटिक्स। और जो परसेंटेज कैलकुलेट होता है वो ऊपर चला जाता है। अंडरस्टैंडिंग? यस और नो? एम आई क्लियर अबाउट दिस? This should be lower. Why? As a higher ratio indicates a dependency on borrowed funds to do business. Now, remember one thing. I'm writing something down in Hindi for you to understand. कर्जे पर ईद या दिवाली नहीं मनाई जाती। ईद हो या दिवाली हो, इसे किस पे मनाना चाहिए? इक्विटी से मनाना चाहिए। You will never celebrate the best moments of your life by borrowing money from people. They will be celebrated out of the money that you have created for yourself without a burden on yourself. So, although borrowings are essential, you need to understand that lower the dependency, the better it is. Lower the dependency, the better it is. Why? Because at the end of the day, you have to repay this money to outsiders. Yeah. Kab tak you will take money from outsiders? You have to have your own sources of funds. So the success of a business is not a good product. The success of a business is not a good product. The success of a business is effective sales made profitably. You can have a really third class product and a really third class company. But if they are doing good sales, they are making profits. You can have a really good product, a fantastic product. But if there are no sales, what's the point of that product? The company will die. The product also will normally die with that company. Are you understanding what I'm trying to say? This is very, very essential for you to understand and get a grasp over. Are you with me on that? Yes or no? Please tell me that. Are you with me on that?
Yes, sir.
Yes or no? So therefore, for your business to flourish, debt to assets generally lower the better, because a higher ratio will mean more risk in the form of interest payments. What is total debt equal to? Non-current liabilities plus current liabilities upon your total assets. This is one of the ratios that we are going to, encounter in today's journey. One of the ratios that we are going to encounter in today's journey. Are we clear about this ratio? Yes or no? Please tell me that. Are we clear about this
Yes,
ratio?
sir.
Does everybody understand? I'm sure I've discussed it in the past, but it's a recap. Please take a screenshot, Rachita. Thank you.
Done.
Taken. Now next. Debt to equity. Very interesting. As I said, equity is owner's money and debt is outsider's money. Who should ideally control the business? Who should control the business? You tell me. Owner or
Owners.
outsider?
Equity.
Owners.
Common sense says what? Owner. Common sense says what? Owner. So obviously, for owner to control the business, what should happen? Your equity funds should be greater than your debt funds. If debt funds are greater than your equity funds, what will happen? Outsiders will try to control the owners. Agreed or disagreed? Agreed or disagreed?
Agreed.
Common sense, right? So, what is total debt to equity? Total debt upon equity. What is total debt? Non-current liabilities plus current liabilities upon equity. Lower the better for two reasons. First reason, lower risk of fixed interest payment. And second, higher control and autonomy of the owners of the company. Agreed or disagreed? Please tell me that. Higher control and autonomy of the owners of the company. Do you agree with my statements?
Yes.
अगर आप कर्जे लेके
Yes.
धंधा करोगे तो कर्जा देने वाला आपको बोलेगा ऐसा कारण है, वैसा कारण है, ये कारण है, वो कर। मैं मेरे पैसे पे कर रहा हूँ, तो मैं 12 घंटा नेटफ्लिक्स देखूं, या मैं 12 घंटा नोट्स बनाऊं, या मैं 12 घंटा लेक्चर लूं, या मैं 12 घंटा सो, ये मेरा चॉइस है, कोई बाहर वाला नहीं बोल सकता है। अब मैंने डेट लिया है और मैं लेक्चर ले रहा हूँ, डेट वाला आगे बोलेगा अरे क्या तुम लेक्चर ले रहे हो, भगाओ, स्टूडेंट नहीं चाहिए, थ्रो देम आउट, गो एंड गेट मोर सेल्स। मुझे क्या करना पड़ेगा? यस जी हुकुम मेरे आका, आप जो बोलोगे वो मैं करूंगा। और हाथ जोड़ के बेचारा मालिक भाग रहा है मार्केट में सेल्स लाने के लिए। मालिक का है, मालिक क्या करेगा? ही विल फोकस ऑन द क्वालिटी, गेट द सेल्स फ्रॉम आउटसाइड। देयर आर वेरियस वेज ऑफ लुकिंग एट द बिजनेस। आर यू अंडरस्टैंडिंग व्हाट आई एम ट्राइंग टू put into your minds over here? Yes or no? Yes or no? Next, like this, like there is a total debt, there can be a long term debt to equity. What is long-term debt? Long-term debt is nothing but non-current liabilities upon equity. Why again? Lower the better. Lesser dependency on long-term borrowed capital and higher dependency on owned funds, owner's money. Also, lower risk of fixed interest payment and better control of owners. My dear students, all of these aspects that you are saying are your qualitative inputs for writing essay questions along with doing the tougher theoretical questions that will come in your MCQ. So here, there are two ratios that you have done: total debt to equity and long-term debt to equity. These are the two ratios that you have done in this particular slide. In all, we have done three ratios so far. First was debt to total assets. Second one was total debt to equity. And third one was long-term debt to equity. Are you with me on that? Yes or no? Please tell me that. Are you with me there? Yes?
Yes, sir.
Now we begin our further journey. Now we begin our further journey into this particular aspect. Rajita, if you can take a screenshot. If you can take a screenshot.
Done, sir. Done.
Taken? Yeah. Now one more aspect I will like to tell you. Here I will like to do one more conceptual recap. I will like to do one more conceptual recap with you of income statement. Sir, you do income statement, you don't do a conceptual recap. You torture us in every lecture with income statement, and this has been happening from capital budgeting. Yes, because that's how important this concept is in your life. First will come sales. From sales, what will I subtract? Variable cost. What will I achieve? Contribution. What will I subtract? Fixed cost. I want you to note that this is fixed operational cost. What is this? This is a fixed operational cost. What will you get? EBIT. From EBIT, what will you subtract? Interest. I'm interested in this aspect over here. What will you get? EBT. Now, basically, interest is paid out of what? EBIT. So if you are borrowing funds or if you are using long-term borrowed funds, you need to have sufficient EBIT to pay the interest. Agreed or disagreed? Here I will say, higher the EBIT, the better it always is. Further, I will say, as a general rule, industry or market counts how many times you can pay the interest from EBIT. What is this called? This is called interest coverage ratio. What is the meaning of interest coverage ratio? How many times your interest is covered by EBIT. How to calculate this? You take EBIT and you divide it by interest. So suppose this is 10 lakhs and this is, let us say, 1 lakhs. Can I say that you have the ability to pay interest 10 times out of your operational funds? Sir, why are you using the word operational funds? My dear friends, EBIT तो आखिर sales में से ही आता है ना? Because EBIT ultimately comes from sales. Agreed or disagreed? Agreed or disagreed? Yes or no?
Agreed, sir.
Does everybody understand this concept? Does everybody understand this concept? Give me a thumbs up.
Yes, sir.
Yes? Everyone? Yes, everyone? Understanding? Rajita, please take a screenshot. Rajita, please take a screenshot.
Done, sir.
Done? Okay. So now, if you have understood this, let us make a chart also. Let us make a chart. I have made a chart, and incidentally, this chart is an MCQ question also. So I will first ask you certain questions. Tell me, what is an operating cycle? What is the meaning of operating cycle? I'll draw over here in small, so you will understand. What do? You buy the goods. Then what do? You sell them. Then what do? You collect the money. Then what do? You pay your vendors. And then what do? Again, you buy the goods from them. What is this? This is called your operating cycle. What does the operating cycle tell you? It tells you in how many days or months your business generates or releases cash. Agreed or disagreed? Agreed or disagreed? Kindly tell me. Everybody, tell me, have you understood this? I'm waiting for responses. I will not go ahead before that. Do you understand this concept? Yes or no? Please tell me.
Yes, sir.
Yes, sir.
Are you sure?
Yes.
Kushi, Danish, Aditya,
Understood, sir.
Priya. Do you understand? Aditya,
Yes, sir. Understood.
understood? So if the operating cycle increases, what is the meaning of operating cycle increases? It shows that more time is needed for cash to be generated. Is this good or is this bad? This is bad or adverse? If the operating cycle decreases, what does it shows you? It shows you that cash is generated faster in your business. Agreed or disagreed? This is good or favorable. So what can I say about operating cycle? The lower or the shorter, the better. Agreed or disagreed? Please tell me that. Agreed or disagreed?
Agreed, sir.
Agreed? Everybody agrees with me. Yes or no, you tell me.
Yes.
Okay. Times interest earned or interest coverage ratio. What is the meaning of this? How many times you can pay interest out of your EBIT? Agreed or disagreed? This is what I just discussed with you. If this is high or it increases, what does it shows you? It shows you that EBIT is high, therefore you have more coverage to pay your interest. Agreed or disagreed? You have more coverage to pay your interest. Yes or no? Please tell me that. Come on, guys. Come on, guys.
Yes, sir.
100% you're with me on that? Let me
Yes.
carry on. Let me carry on. So, this is good or this is favorable. If this is low or this falls, this shows you that EBIT is falling. Therefore, you have lesser coverage to pay your interest. This is bad or this is adverse. So over here, for this ratio, higher the better. Agreed or disagreed? Agreed or disagreed?
Agreed, sir.
Debt to equity ratio. What is the meaning of this? Debt or borrowed funds expressed as a percentage of equity. So if this ratio is high, it shows you that there is a higher dependency on borrowed funds to do business. This is risky and this is bad. If this is low, there is a lower dependency on borrowed funds to do business. This is less risky and this is good. So obviously, what will I write over here? Lower the better. Agreed or disagreed? Agreed or disagreed?
Agreed.
Days sales in accounts receivable. You have all read this notes, you have all attended the lecture. Means what? How many days my credit sales are outstanding? Meaning मेरे डेटर्स से पैसा कलेक्ट करने को कितना टाइम लगा? How much time it takes for me to collect the money from my debtors? Should this be high or should this be low? You tell me that.
Low.
Of course, it has to be low. If this is high, it shows you more time to collect cash from debtors. This is bad. And if this is low, it shows you shorter time to collect cash from debtors. This is good. So what should I say for this? Lower the better. Agreed or disagreed? Agreed or disagreed? Come on, students.
Agreed, sir.
Everybody agrees with my statements? These are your 4 ratios. These are your 4 concepts. These are your 4 ratios. These are your 4 concepts. Please take a screenshot of this. Please take a screenshot of this. Taken? Screenshot is
Yes, sir.
taken?
Yes. Yes.
Question number 48. Question number 48, 4968. An increase in which of the following measures would be considered beneficial? Operating cycle. If it increases, more time to collect cash. Times interest ratio. If it increases, EBIT is more. Debt to equity ratio. If it increases, debt is more. Days sales in accounts receivable. If it increases, longer time to collect your money. So what is your answer? Times interest earned. Sir, what is the justification of this particular one? My dear friends, we just drew an entire chart for the justification of this particular ratio. Yes or no? So what is this? This is your justification to question number 48, MCQ number 4968 from Becker. If you read this and you understand this concept, will you or will you not be able to answer the MCQs? 100% you will be able to answer the MCQs. Yes or no? Yes or no,
Yes, sir.
students? So today is Albas's first lecture, but still is able to answer. How come? Because of the conceptual understanding, right? So Rachita, you have this screenshot with you.
Yes, sir.
Just delete that and take this one because I have written the Becker question number over it. Okay, just take it.
Take.
Taken? Now let's rub this and let's go to the screen. Let's write over here. Let's write over here also. Operating cycle, if it increases, more time for cash to be generated or more time for cash to release. That is bad. Times interest earned, if it is more, EBIT is high. That shows you can cover interest far better. Debt to equity, if this gets high, then debt is greater than equity. Financial leverage will be high. Financial risk will be high. Interest cost will be high. Outsiders control will be high. This is very bad. This is also bad. This is good. This is bad. Days sales in account receivable. If this increases, an increase they are asking. They are asking an increase. So if this increases, what will happen? More time to collect cash. From your debtors, which is again bad. So what is your answer? Your answer is point number B. I'm putting a white flag on this because it's a good question. I can play around with this question. A decrease in which of the following measures will be considered to be adverse? Same question I can ask. Answer will be times interest ratio. So I'm giving you an extra question. How will I redraft an extra question with same options? With same options. A decrease in which of the following measures will be adverse? What is your answer? Your answer continues to be B. The answer is also the same. The answer is also the same. I just played along with the interpretation of the ratio. Please take a screenshot of this, Rachita. Please take a screenshot of this. Let me know when taken. Let me know when taken.
Done, sir.
Done? Okay. Now let's solve questions non-stop for some time. I believe quite a bit of conceptual explanation has been given. Now we have to do questions from where? We have to do questions from this 53 up to this 40. These 13 questions now we have to deal with. Question number 13. How this question came, that from where the story started. From where the story started. Now let us pay attention. At the beginning of the year, a company reported total assets of 50 million. So I will say beginning. So rather than beginning, I will be professional and I will say 1st of January 20XX. Whatever is the year. Whatever is the year. What do I have? Total assets is how much? 50 million. Stockholders' equity is how much? 34 million. My dear friends, therefore automatically can I say that total debt? Can I say that total debt is $16 million? Yes or no? Please tell me that. Yes or no? Please tell me that. Do you agree? Balance sheet equation. Sir, I am giving the answer in the screen. अरे छोड़ना उसको. मेरी बात सुन. मेरी बात सुन. मेरे को आता है. मेरी बात सुन. मेरे को आता है. मेरी बात सुन. Listen to me. ये बराबर है? Everybody agrees with what I wrote over here?
Yes, sir.
Yes or no? Okay, sir. Okay, sir. So on the basis of this, can I do the following ratio? Now this over here are all beginning, and this over here I will write all year end calculations. Okay, beginning. My first ratio that I am writing, debt to assets. What is it? Debt upon total assets. What is your answer? 16 million divided by 50 million. What is your answer? Yes or no? 16 divided by 50. What is your answer? 0.32. What is the meaning of this? 32% of assets are financed by debt. Agreed or disagreed? Yes or no?
Agreed.
First one. Second one. Debt to equity. Debt total upon equity total. What is your answer? What is the meaning of this? 16 divided by 34. What is the answer? 0.47. It means that 47%. Yes, Aditya?
Excuse me, sir.
Yes.
The total asset is 55 million, right, sir? And you have
At the
written
beginning
50.
of the year. 50
Okay.
million. Beginning is 1st of January.
Okay, sir.
End is beta 31st of December. No?
Yes, sir. Yes.
I have not yet come to the end only. I am
Sure,
still
sir.
ruminating on the beginning.
Okay, sir.
Okay. So can I say that 47% of equity is equal to debt? मतलब जितना इक्विटी आपने लगाया उसका आधा borrowed किया था. Means if you are investing 100 rupees, 47 rupees you are taking loans. Did you understand? Yes or no? This last statement I'm rubbing because people will get confused. Are ye why you are writing like that? Everybody will say. So let it be. So I will just leave the calculation to this. Now somebody will ask me, sir, do this calculation also. Long-term debt to equity. My dear friends, here it is not possible. Here it is not possible to calculate, as current liabilities and non-current liabilities breakup is not given. As current liabilities and non-current liabilities breakup is not given. Are you with me on that? Yes or no? Please tell me that. Are you with me there?
Yes.
Now, 31st of December 20x1. This was your beginning and this is your end. At your end, now as Aditya correctly pointed out, what are the total assets of the company? 55 million. What is the total equity? 44 million. Therefore, what is your total debt? 11 million. Now, let's begin. Debt to assets is equal to what? Debt upon total assets. Sir, why are you writing the formula again like an idiot? Because idiotics like this should be repeated. This is called practice, and practice makes you perfect. Imagine if you are replicating my notes in a notebook, and just the way I have written, you are writing the formula those many times. Will you or will you not be revising in the process of your studies also? You tell me that much. Understanding? When I say that I guarantee you that
Yes.
one way or the other, I will make you to pass. गद्दा मजूरी करने के लिए तैयार हो जाओ. Practice is the only way to pass this exam, or for that matter, any goddamn exam. Practice. What are the debts at the end? They are 11 million. And what are your total assets at the end? They are 55 million. So what will this be? 11 divided by 55. It is 0.2. What is the meaning of this? At the beginning of the year, 32% of your assets were financed by debt. Now 20% of your assets are financed by debt. My dear friends, let us talk like professionals. The CFO has done a fantastic job. CFO has done a fantastic job. Sir, why you are saying like that? Because he or she has reduced the dependency of debt as a source of financing, as a source of financing from 32% to 20%. At the beginning of the year, 32% of your business was controlled by borrowed money. At the end of the year, only 20% is controlled. So you have slashed down. आपने कर्जा कम कर दिया है, आपने खुद का पैसा ज्यादा लगाया है, आप बिजनेस के ऊपर खुद का कंट्रोल ले रहे हो. Are you understanding? Yes or no? Please tell me that. That's the concept of this question. अरे नहीं तो कोई भी Tom, Dick and Harry will tell you that what are they asking you? Debt to assets. Any Tom, Dick and Harry over here can tell you that your answer is 0.20. You have not come here to Apex to do all this rubbish. You have come here to understand the meaning of 0.32 has fallen to 0.2. What is the meaning of that? Read beyond the lines. Read under the lines. What is the gospel truth behind the lines? What is the gospel truth? The gospel truth is the CFO is a brainy fellow. He saw at the beginning of the year, my goodness, 32% of my assets are financed by debt. It's not good. Let me fuse in more of the owner's funds. Let me repay the debts. Let me create more assets by generating profits out of equity. And what will I do? I will reduce the dependency on outsiders. What has the CFO eventually done? My dear friends, CFO has reduced risk. CFO has reduced risk. People keep saying, hey, risk management kya hota hai? What is this risk management as a profile? What is this risk management? This right here is risk management. This is what you are supposed to do as a CA, CMA. All this you are supposed to do as a CFO. Understood? Next is debt to equity. What will be your answer? Total debts upon equity. What is your answer? $11 million. What is your equity? $44 million. What is your answer? 11 divided by 44. 25%. 0.25. My dear friends, please notice earlier it was 47%. Now it is 25%. Look at what has happened. Earlier, if you are investing 100 rupees, borrowed rupees were 47. Now, if you are investing 100 rupees, borrowed rupees are 25. It shows that you are doing business more with owned funds. So, if debt to equity has fallen from 0.47 to 0.25, it is not good, it is excellent. As you are relying more on owners funds, ये funds clearly नहीं दिख रहा है, owners funds to do business rather than taking the borrowings. Are you understanding this concept, ladies and gentlemen? If yes, give me a thumbs up. If yes, give me a thumbs up. Yes? Aditya, Rajita, Kushi, Tanesh, Priti,
Yes, sir.
Lokesh,
Understood.
Haripriya, Nasla, Albas. Are you understanding, guys? Yes or
Yes,
no?
sir.
Priti, you're there or you
Yes, sir.
slept?
No, sir, there.
You're there? How are you?
I'm fine, sir.
Good, good. I am handsome. Can't help it. Allah made me this way. Chalo, take a screenshot. Take a screenshot.
Done, sir.
Yes, understanding. Understanding now. Let's go. I don't remember which question. This was 53. Let's go to 52. What is 52? How is the current ratio affected when a company issues stock? Now, see, understand one thing. In India, I'm doing this for clarity. In India, for us, stock, it means goods or inventory. In America, stock or common stock, it means equity share capital. First of all, understand this terminology difference. I know you might know this. I'm just pointing it out for your better. Right? For India, for us, stock is goods or inventory. But in USA, what is stock? Equity share capital. So what we have to do? America Jindabad. Correct? We have to do America Jindabad because we are doing US CMA. Right? No option. Now, how is current ratio affected? When a company issues stock in exchange for cash, pass the journal entry. Debit, what comes in? Cash bank account debit to equity share capital account. They are asking you current ratio. Now, over here, I'm writing the following things. Current assets have gone up. Current liabilities are unaffected. Therefore, in current assets upon current liabilities, automatically the numerator has increased. Therefore, the current ratio obviously has to increase. Current ratio decreases because current liability increase is wrong. Current ratio increases because current assets increase is the correct answer. Current ratio decreases is the wrong answer because equity increases. What is this rubbish? Equity is not related to current ratio. ऐसा फालतू बात नहीं करने का इधर. It's a stupid statement. It's a stupid statement. There is no change in current ratio. This is also wrong. Why? Because current assets are increasing due to cash account debit. So this is also wrong. This is also wrong. This is also wrong. This is correct. I hope everybody understands it. Take a screenshot. The question is over. Take a screenshot. The question is over. We have discussed this type multiple yesterday. Yes, Rajita, you have doubt? You have doubt?
Sir, I said I'm done.
You have
I
doubt?
will take.
So we have discussed this type of question multiple yesterday. We have discussed multiple yesterday. Today, ruminating over this does not really add value to your life nor mine. So take a screenshot. We are done with this. 51. Question number 51. What is 51? Which one of the following statements about interest coverage ratio is true? Now please understand, interest coverage ratio, first of all, is a leverage ratio because it calculates the coverage of a fixed financial cost by EBIT. It is not a liquidity ratio. UUIDITY. It is not a liquidity ratio. It is a liquidity ratio? No. It is a leverage ratio calculated with income statement information. Yes. Sir, how you are saying income statement information? My dear friends, what is that? EBIT upon interest. Both these items are from income statement, na? Yes or no? Yes or no?
Yes, sir.
You remember your income
Yes.
statement format? I will
Yes.
say over here, refer to the income statement format Pushkar has done 1 crore times. I'm purposely writing Pushkar has done it 1 crore times. But if you ever goof up in the income statement format, you know I'm going to scold the life out of you. क्योंकि every day मैं income statement लिख रहा हूँ. Believe me, sometimes when you meet me, you should not say good afternoon Pushkar, good morning Pushkar. You should say hi, sales minus variable cost is contribution minus fixed cost is equal to EBIT minus interest is equal to EBT minus tax is equal to EAT minus preference dividend is equal to earning available for equity shareholder divided by number of equity shares is equal to earning per share minus dividend per share is equal to retained earning per share. How are you, Pushkar? That is what you should say to me. The day you say hi, I'll be depressed. I'll be like, actually, you forgot income statement. You should remember the income statement like this. I am not showing off. This is only a result of practice. You practice, you will be able to do it. You practice, you will be able to do it. Yes or no? Yes or no?
Yes,
It's
sir.
just a practice. Liquidity ratio calculated, it is not a liquidity ratio and it does not use balance sheet information. It is a leverage ratio, it does not use balance sheet information. What is it? It is a liquidity ratio using income statement info. Agreed or disagreed, everybody? It is a
Agreed, sir.
liquidity, it is a leverage ratio which is using the income statement information. Agreed or disagreed? Okay, take a screenshot. Let's go to
Done,
the
sir.
next question. Just 1 second. Just pause the recording for 1 second. So this is over. Which was this? 51, now 50. The interest expense for a company is equal to its earnings before interest and tax. Okay, interesting. Sales minus variable cost is equal to contribution minus fixed cost is equal to EBIT 10 lakhs minus interest is equal to 10 lakhs. So EBT is equal to nil. So is EBT is equal to nil. Always keep in mind one thing. If your business earns only enough to pay the words over here important are only enough to pay the outsiders, that is the lenders, comma, the equity shareholder will die hungry. For a company to maximize equity shareholder wealth, it is extremely essential to create EPS. To create EPS. Of course, EPS will then be multiplied by your PE to give you MPS. Here, what are they saying? EBIT is equal to its interest. Therefore, EBIT upon interest is equal to 10 lakhs upon 10 lakhs is equal to 1 times interest earned ratio is how much? It is equal to 1. But over here, I am not interested in times interest earned ratio. I am interested in this crucial concept. What is that crucial concept? अगर लोन ले रहे हो तो ना सिर्फ लोन का पैसा चुकाना है बट मालिक के लिए भी पैसा कमाना है. लोन नहीं ले रहे हो तो जो भी कमाई हो रही है सारी की सारी मालिक के जेब में जा रही है. Keep one thing in mind. If you have got borrowed funds, two people will eat. Who are they? Lenders, and after lenders, owners. Always remember they will eat after the lenders. But if there are no borrowed funds, only equity, then only owner will eat. And this is the ideal scenario. This is the ideal scenario. Are you all with me on my statement? Are you all with me on my statement? Yes or no? Please tell me.
Yes, sir.
So there is a very, very important learning. Interest is bad. I will go on to say interest is evil. Avoid interest. Always keep that much in mind. Avoid interest. These are your important learnings of finance, that you have to avoid the interest. Are you understanding what I'm trying to say? Yes or no? Please tell me that. Yes or no? Please
Yes,
tell me.
sir.
Agreed?
Yes, sir.
Take a screenshot. Take a screenshot.
And sir.
Which was this 50? Now 49 times interest earned ratio for year number 2. Now see, purposely now they have what do you call it? They have just what I can say. They have just given you a complicated sort of format. They've given you a complicated sort of format. Last thing I want is any one of you to get confused over here. Last thing I want is any one of you to get confused over here. Now pay attention to what I'm saying. Right? See, sales minus COGS is gross profit minus operating expenses. Gross profit minus operating expenses is EBIT. Right? So year 1, year 2. Operating is gross profit for year 1 is how much? 9 lakhs. And operating expenses are how much? 4 lakhs. What is your EBIT? 5 lakhs. What is your interest? 60,000. What is my ratio? Times interest earned. What is the ratio? Times interest earned. They are asking for year 2. That's okay. So what is your answer? It is A divided by B. What you will get? 5 lakhs divided by 60,000. What is your answer? 8.33. Sir, why are you doing for year 1? So that I can do a comparison on this company's financial performance. If you are just calculating for 1 year and going, then you are not a real CMA. A CMA should be able to analyze. He should have an analytical ability. He should have a questioning mind. He should be able to challenge the covenants of finance. That is what I'm teaching you to do. Here, what is your gross profit? 10 lakhs. What is your operating expenses? 4,50,000. What are you left with? 5,50,000. What is your interest expense? 50,000. Now, what is your answer? What is your answer? 5,50,000 divided by 50,000. What is your answer? 11 times. And here, what is your answer? 8.33 times. Let me check. 5 lakhs divided by 60,000 Yes, it is 8.33 times. My dear friends, notice my comments. Notice my comments. Number one, company has earned higher EBIT, correct? 5 lakhs to 5.5 lakhs, and has I will say correspondingly or parallelly reduced its interest burden from 60,000 to 50,000. Automatically, it can cover interest more from 8.33 times to 11 times. So here, operations are good because EBIT increased. Next, CFO is good because interest reduced. Here it is not the operational responsibility to reduce the interest. Here interest reduction is a part of capital structure planning. It is a part of capital structure planning for which CFO, that means you in future, are responsible. So here both the aspects are covered properly. So why are you doing like this? Do you remember in part 1 in standard costing, they used to keep asking you this question: who is responsible? Purchase manager, production manager, operational manager, falana dimka. Here they might not ask you like this right now in Baker. That is the short-sightedness of Baker study material. I'm saying it publicly. I might even put this on YouTube. It is a short-sightedness of Baker study material. As a CFO of the future, you need to understand that you have to pinch the COO to do the right things. You have to pinch yourself to have the right capital structure. Otherwise, the CEO will pinch you to death. Keep that much in mind. Ultimately, credit goes to CEO. But you have to do your job because see, this is whose job, this is COO's job. This is whose job, this is CFO's job. Ultimately, who they go into? They go into the CEO. You need to keep that much in mind. So that is essential. So what is the times interest earned? The answer is 11 times. So somewhere you'll find that over here. Somewhere you'll find that 11 times. Here the answer is 11 times. So I'm not interested in answer 11 times. I'm interested in the other comments and the calculation. So please take a screenshot. Thank you. Please take a screenshot. Taken?
Yes, sir.
Now we have finished from what? 54 to 48. Okay. We have to finish now from where? 47 to 20. Apna 30, 29 we touched upon, and we are going to do tonight. We're going to do tonight. Here, let's take a 2-minute break. Okay.
49.
So, 48
49 is done.
is done, correct? 47 is not done. Okay. So let us go to question number 47. Interesting question. Interesting question. Why is it interesting? It is interesting because it has got an important concept attached to it. Now, what is an important concept? The important concept also can be drawn out over here. Now, this question is speaking about degree of financial leverage. This question speaks about degree of financial leverage. Let's pay attention. Okay, why is this coming over here? This can't go over. Thank you. Financial analyst calculated company's degree of financial leverage as 1.5. Fine. Degree of financial leverage has got two formulae for its calculation. Can anybody tell me what those formulae are? Sakshi, Aditya, Monica, Rachita, Khushi, Lokesh,
EB
can somebody tell me?
EBIT divided by
Yes,
EBT.
sir.
EBIT divided by
EBT.
EBT, correct? Now please understand, EBIT minus interest is equal to EBT. So this can also be written as EBIT upon EBIT minus interest. What are we doing? We are isolating interest in this calculation. This is also written in terms of delta as percentage delta earning per share upon percentage delta EBIT. And this is going to be a fantastic conversation in ahead for operating leverage, because this is a very good question. I think that is question number 30. I've earmarked that question. Now I'll purposely jump to 30 from here. What they are saying? They are saying that a financial analyst calculated the company's degree of financial leverage as 1.5. So degree of financial leverage is 1.5. If net income before interest increases by 5, increases means delta is 5%. So degree of financial leverage is equal to percentage delta earning per share upon percentage delta EBIT. This is equal to 1.5. So continue over here. Percentage delta EPS upon 5 is equal to 1.5. Therefore, percentage delta EPS will be how much? 7.5. 5 will go over here. Therefore, your answer is 7.5. Therefore, what is your answer? 7.5. Good question. Why? Because it helps you to revise the formulae by the help of this screenshot when you are going through this in your revision time. Please take a screenshot of this so that I can move to the next question immediately. Kindly let me know when taken. Taken? Okay. Now, let us look at question number 30 immediately. It's going to be a long discussion. Now, a company with a high operating leverage will do what? Okay. Now, let us analyze each one of these carefully. Now, first of all, understand that company has a high operating leverage. Please understand that operating leverage is a measure of what risk? It is a measure of operational risk. It's a measure of operational risk. Operational risk will exist because there are higher fixed costs of operations. Means company is relying more on fixed cost than on variable cost to grow its business. Now let us pay attention. Degree of operating leverage, that is DOOL. We have got elaborate notes made on DOOL. If you remember, if you go and if you have seen the DOOL lectures, have you seen it? Sakshi, Aditya, Rachita, Kushi,
Yes, sir.
Preeti, Danish has not, I know, Lokesh, Monica, Haripriya, you have seen all those lectures? Apna location, all you have seen those lectures? You have attended it? Okay, if you have seen, attended, if you have seen and you have attended, what is essential for you to note? What is essential for you to note is that we have got good notes of this in the DOOL charts. There are DOOL charts. What is the first note on the DOOL chart? The first note is DOOL is equal to contribution upon EBIT. Sir, this can also be written as contribution minus fixed cost. Sir, what are you saying? Yes. Sales minus variable cost is contribution. Contribution minus fixed cost is equal to what? EBIT. So what is EBIT? EBIT is nothing but contribution minus fixed cost. So I wrote it like that. Correct? The second in the DOOL chart was percentage delta EBIT upon percentage delta sale. This is a very important and a crucial formula. I am making a statement. What is my statement? My statement is a relatively small change in sales will make a relatively greater change in EBIT. Sir, what is the meaning of this? I will explain. Let us see case A. In case A, I have sales of 12 lakhs. I have variable cost is 30%. So 12 threes are 36. What I have got over here? Contribution. How much is that? 8 lakhs and 40,000. Now please understand that a company has high operating leverage means operating fixed costs are high. So I will take that to be 6 lakhs. What I have got? EBIT 2 lakh and 40,000. Case B. A relatively small change in sales. Sales increases by 16.67%. So 12 lakhs plus 16.67% will give you 14 lakhs rounded off. Variable cost, as I said, is 30%. So 14 threes are 42. What I've got left? Contribution. So 14 lakhs minus 4 lakh 20,000. What is the answer? 9 lakh 80,000. Minus fixed cost. My dear students, fixed cost stays fixed. What is the funda? Fixed cost will stay fixed only. Fixed cost stays fixed. You remember this from part 1. Fixed cost will not change.
Yes, sir.
Let the degree of volume of operation change. But in a range, the fixed cost will stay fixed. Now, what is your EBIT? Your EBIT is 3 lakhs and 80,000. Now, please understand. Delta sale. Delta sale means change in sale is 14 lakhs minus 12 lakhs. So, percentage delta sale is equal to 2 lakhs. Percentage delta sales is equal to 2 lakhs divided by 12 lakhs multiplied by 100, which is equal to 16.67%. Check once, 2 divided by 12 percentage. Yes. Now, what is your delta EBIT? 3 lakh 80,000 minus 2 lakh 40,000. What is your answer? 1 lakh 40,000. Don't make the blunder. Don't make the blunder of comparing 2 lakhs with 140. We are comparing relative change. We are comparing relative change. And relative change is always a percentage. Therefore, what is percentage delta EBIT? Notice it will be 1 lakh 40,000 divided by 2 lakhs multiplied by 100. So 140 divided by 200 percentage. What is your answer? Sorry, 140 divided by 240. 140 divided by 240. Why? Because this was originally 240, na? Percentage. So 140 divided by 240 percentage. What is your answer? 58.33%. Now compare 58% by 16%. So can I say over here that when sales increased by 16.67%, EBIT increased by 58.33%. Look at the whooping impact of sales on EBIT. Isn't this a whooping impact? Sales इतना बढ़ा, EBIT साला इतना बढ़ गया. Sales इतना सा बढ़ा, EBIT साला इतना बढ़ गया. Are you understanding what I'm trying to say? Are you understanding? So in case of
Yes.
companies with a high fixed cost, that is a high degree of operating leverage, comma, a small increase in sale will give you a relatively, this is a very important word, relatively very high increase in EBIT. Relatively very high increase in EBIT. Are you convinced with my calculation? Are you convinced with my calculation? Yes or no? Please tell me that. Everybody, are you convinced with
sir.
my calculation?
Yes, sir.
Sakshi, Monica, Rachita, Kushi,
हाँ sir.
Preeti, Danesh, अपना आदित्य, लोकेश, हरिप्रिया, and Albas. Are you convinced with my calculations? Are you convinced with my hypothesis? Yes or no?
Yes, sir.
Yes.
Yes, sir.
This is your question number 30. Your MCQ number is 7773. And this is from Baker. ये continue रहेगा. This MCQ will go on for a long time now. You are convinced with this that a small increase in sale will give you a relatively very high increase in EBIT. 16.67% increase versus, purposely I'm drawing a big arrow, 58.33% increase. Yes or no? Justified statement? Yes or no? Justified the statement?
Yes sir.
Convinced? Rajita, please take a screenshot.
Done sir.
Done? Now pay attention. What are they saying here? They are saying over here that a relatively small change in sales will have a smaller impact on profits. This is wrong. It will have a much larger impact. It will have a much larger impact on profits. Do you understand why this statement is wrong? Why the first statement is wrong? Do you understand? Yes or no? They are saying small change in sale, small impact on profit. No, small change in sale, very high impact on profit. Yes or no? Please tell me that.
Yes sir.
Agreed?
Yes, sir.
Agreed?
Yes.
Everyone? Everyone agreed?
Agree.
Yes, sir.
Yes sir.
Let's go ahead. We will observe that new sales can be achieved only through additional costs. This is a wrong statement. Now, I am analyzing over here statement B. Now, please understand what I am trying to say. See, the company already has a high fixed cost of operations. As it has a high degree of operating leverage. Now, if for additional sales, comma, additional costs are incurred, these additional costs are proportionate to sales, that is, they are variable costs. Please digest this statement. Please digest this statement. सेल बढ़ाने के लिए जो कॉस्ट किया बढ़ाने के लिए वो वेरिएबल है कि नहीं है, मुझे ये बताओ। कॉस्टिंग का बेसिक नॉलेज यूज करो। कॉस्टिंग लेक्चर नंबर 1, जिसके पास भी नहीं रहेगा यूट्यूब का लिंक दे देता हूं, शांति से पहला लेक्चर एपेक्स का देखना। उसमें फर्स्ट इनिशियल लेक्चर, वेरी फर्स्ट लेक्चर ऑफ एपेक्स दैट आई टुक विथ योर ब्लेसिंग्स, उसमें मैंने क्लियरली बोला था द कॉस्ट दैट इंक्रीजेस एज द सेल्स विल इंक्रीज इज अ वेरिएबल कॉस्ट। आप बोल रहे हो, यू आर सेइंग टू मी दैट टू इंक्रीज द सेल्स you have to increase the, you have to incur the additional cost. That means the additional cost has to be a variable cost, boss. Why the heck will I incur an additional cost when I'm already having such a huge fixed cost? Are you understanding? Yes or no? Yes or no?
Yes, sir.
This will show that company is relying on variable cost to increase the sale, which is not true, as company relies on heavy fixed cost. Yes or no? Please tell me that company relies on what? A heavy fixed cost? Yes or no? Come on, tell me, tell me.
Yes.
Company is relying on a heavy fixed cost? ये तो झूठ है मिलॉर्ड, ये तो झूठ है. Why is this false? Refer this. It will have not a smaller, it will have a higher impact. Refer previous screenshot. Correct? We'll have greater risk and greater potential return. Always keep one thing in mind. Higher fixed cost means higher risk. And डर के आगे जीत है, रिस्क से इश्क है, all that rubbish. Higher risk always means चली तो तीर नहीं तो फकीर, चली तो तीर नहीं तो फकीर. Higher risk always means higher returns, or you are begging, or you are begging. Risk means या तो आप आसमान की बुलंदियों को छू रहे हो, या तो जमीन के नीचे 6 फुट मट्टी के दाने गिन रहे हो. It is only one of that. It cannot be both. It cannot be both. Please understand. Higher risk always means higher return. Always keep that much in mind. Where degree of operating leverage is high, comma, EBIT is expected to be high. Please understand this. We'll have a less risk. No, this is a wrong statement. If degree of operating leverage is high, comma, risk is high, and less potential return is a meaningless statement, because this less risk only is a meaningless statement. If dual is high, risk is high. Therefore, by that justification, this, sorry. By that justification, this is your answer. I meant to click on C. I made a mistake. What is your answer? Your answer is option number C. Your answer is option number C. Are you with me on that? Yes or no? Please tell me. Are you with me on that? Everyone?
Yes, sir.
Do you understand this MCQ? Is a very deep MCQ. Huh? This is not your regular MCQ. This is a very, very deep and thought-provoking multiple choice question that they have asked. Are you all with me when I have answered that question? Can I go ahead?
Yes, sir.
Okay.
Yes.
Rachita, please take a screenshot.
Yes.
Rachita, please take a screenshot. Taken? Okay.
Sir.
Okay. Now, which all questions I have left behind? I want to touch upon those questions. Okay. Now, question number, I believe 46. A company has $1 lakh of total assets and $80,000 of total liabilities. Okay. And 20,000 firm liabilities are current liabilities. Okay. Total assets are 80,000. Total liabilities. Total assets are 1 lakh. Sorry. Total assets are 1 lakh. and total liabilities are 80,000. This 80,000 is broken into 20,000 as current liability. So obviously 60,000 will be what? Your non-current liability, and obviously 20,000 will be what? Total equity. First question, total debt to assets or as debt to total assets. What will it be? It will be total debt divided by assets. What is your answer? 80,000 divided by 1 lakh, which is equal to how much? 0.80. Therefore, can I say 80% of total assets are financed from borrowings. फुल ऑन कर्जे पे दिवाली कर रही है, फुल ऑन कर्जे की BMW, कर्जे का घर, कर्जे का कपड़ा, कर्जे का जूता, एकदम टोटल शाहरुख खान बन के घूम रहा है, लेकिन अंदर ही अंदर विजय मलिया है, फुल बिक चुका है, खत्म हो चुका है. 80% of your existence is debt. You're screwed, right? This is your first one. Total debt to your assets. Second one, long-term debt to equity. This can be calculated now. Here I require long-term debt upon equity. What is the answer? It is long-term debt is 60,000 divided by equity, which is how much? 20,000, which is equal to 3. What is the meaning of this? You have borrowed 3 times what you have invested from your own pocket. 3 times of what you have invested from your own purse. खुद का पैसा 1 रुपया है, तो कर्जे का पैसा 3 रुपया है, ऐसा करके 4 रुपया तुम्हारे पास. Very bad position. Next, third ratio that we learned was debt to equity. Over here we will take total debts upon equity. Your total debts are 80,000 divided by this 20,000. Your answer is 4. Your answer is 4. So you can see why they have done the various numbers or whatever. So over here, what is your answer going to be? What are they asking? Long-term debt to equity. What is long-term debt to equity? It is 3. So we select on 3. Are we clear about this? But we have done extra calculation of all these ratios, which I have discussed with you earlier. Correct? So in one question, we have solved 3 questions. Are you with me on that? Yes or no?
Yes, sir.
Yes?
Yes, sir.
Super. So we are doing more only. But it's good. It's helpful for you. So do take a screenshot. Take a screenshot. Next. Question number now. Which one? 45, I think. Question number 45. Again a good question. Again a good question. What are they doing in this question? Pay attention. Debenture bonds means what? Non-current liability. Preferred equity, preference share capital. It is a part of equity. It is a part of, that is owner's funds. It is a part of that. Common equity is nothing but equity share capital. Financial leverage of Silvan Corp will increase. Please understand, they are saying financial leverage will increase. What is the meaning of financial leverage will increase? It means that financial risk will increase. When does financial risk increase? Financial risk increases when non-current liabilities or borrowed funds will increase. Or equity is bought back and borrowed funds are as it is. Bought back means equity तुम लोग बाय बैक करोगे तो तुम्हारी इक्विटी कम हो जाएगी और तुम्हारे बोरोड फंड जैसे के तैसे रहेंगे, तो तुम्हारा क्या हो जाएगा? जिधर भी फिर तुम्हारा you will have more of debt. So please keep one thing in mind. Now this is a fantastic takeaway that financial leverage, if it is increasing, you need to understand that debt to equity ratio has increased. Debt to assets ratio has increased. You need to understand that long-term debt to equity has increased, right? And where financial leverage has fallen, you need to understand that debt to equity ratio has fallen, debt to assets has fallen, and long-term debt to equity, that has also fallen. Do you agree with the analogies that I have made over here? Do you agree with these analogies? Yes or no? Please tell me that. Financial leverage will increase means debt will increase. If debt increase, then debt upon equity will increase. Financial leverage will increase means debt upon assets will increase means debt will increase. LTD will increase, financial leverage will increase. But if leverage falls, that means the fraction is becoming smaller. Either the denominator has become great, means the equity has increased or the assets has increased or equity has increased, or the numerator, that is all the kinds of debt, has fallen down. Do you agree to this statement? Yes or no? Please tell me that. Yes or no? Please tell me that. Or do you want me to
Yes,
write
sir.
a separate note and explain
Yes,
this
sir.
again? Please tell me, a separate note is needed in notebook.
No, sir.
You want, anybody wants, Monica, you need it or you have understood it? Tell
Understood,
me,
sir.
don't hesitate.
Understood, sir.
You're sure? Rachita,
Yes, sir.
Kushi, Preeti, Danesh, Aditya, Lokesh, Haripriya, Albas. Have you understood it? Have you understood this analogy? Give me response.
Yes, sir, understood.
Understood? Is a separate note needed?
No, sir.
Okay. So now, when will this increase? This will increase when debenture bonds will increase or equity will fall. Correct? Now, issuing common stock and using the proceeds. What is the question? Issuing common stock and using the proceeds to retire preferred stock means what? Issuing common stock. I think we should shift this to the notebook only. I think we should shift this question to the notebook. Just hold on 1 second. Hold on 1 second. You can all see the question clearly? You can all see the question clearly? Yes?
Yes, sir.
Yes.
So can I say that these are borrowed funds and they will result in financial leverage? Can I say that these are owned funds or owners funds? Correct? So I am saying that when borrowed funds will increase, comma, financial leverage will increase. When owners funds will reduce, financial leverage will increase. When borrowed funds will reduce, financial leverage will reduce. When owners' funds will increase, financial leverage will reduce. Debt to equity debt to assets, long-term debt to equity. If all of these ratios are high, the degree of financial leverage is correspondingly high. But when debt to equity is, why are they high? Because debt is high. Why are they high? Because debt is high. But when debt to equity is low, degree of financial leverage is low. When debt to assets is low, degree of financial leverage is low. When long-term debt to equity is low, degree of financial leverage is also low. Why? Because debts are low. Keep this much in mind. Am I clear about this, ladies and gentlemen? Yes or no? Please tell me that.
Yes.
Clear?
Yes, sir.
Now, if you are issuing common stock and are using the proceeds to retire the preferred stock, what is the journal entry that I will pass? In part number A, for A, I am saying, for A, you are retiring preferred stock, means preference share capital is being retired. So the journal entry will be preference share capital account debit. It is gone out of the books to equity share capital. My dear friends, please understand here your overall equity position is unchanged. Why? Preference and equity are both a part of owners funds and एक कम हो गया दूसरा ज्यादा हो गया. It is as good as saying that short term marketable securities are sold for cash. What is the impact on quick ratio? No impact. Cash is becoming cash. So your one source of equity is changing itself into another source of equity. Yes or no? Please tell me that. Yes or
Yes,
no?
sir.
One source of equity becomes another source of equity. Agreed or disagreed? So financial leverage will not increase. Your financial leverage is unchanged. Agreed? Let us go to box question number entry number B. Issuing common stock and using the proceeds to retire debenture bonds. Very interesting. Issuing common stock. Debit what comes in? Cash bank account debit. To equity share capital. What did you do? Issue of common stock. Then what did you do? You paid off the debenture bonds. Debenture bonds are fundamentally a liability. They will have credit balance. Now I'm paying them off. So debenture account debit to cash bank account. What is this? Retirement of debenture stock. What happened over here? Over here, essentially, equity increased and debt reduced. So financial leverage has reduced in entry number B. Do you understand why financial leverage has reduced? Because
Yes,
debt
sir.
has reduced. Yes or no? Please tell me that.
Yes, sir.
Here तुम्हारा debt नीचे गया. Monica, Aditya,
Yes, sir.
understanding or no?
Understand.
Are you sure?
Understood.
Yes, sir.
Yes, sir.
Now I'm doing triangle, entry number C, financing its future investments with a high percentage of bonds. Triangle, which is which one? Entry number C. This is for your entry number C. You are issuing bonds for money. Debit what comes in? Bank account debit to bond account. What happened over here? Over here, the bonds went up. Therefore, your borrowed funds went up. Therefore, your financial leverage went up. What is your answer? This is your answer. Number D, financing its future investments with high percentage of equity funds. I will draw a ulta triangle for this. So ulta triangle, option number D, please pay attention. Financing by equity funds, debit what comes in? Bank account debit to equity share capital. What happened? Your equity went up. So obviously your financial leverage went down. So this is wrong. This is wrong. This is wrong. What is your answer? Your answer is option number C, because this will lead to an increase in borrowed funds. This will lead to an increase in what? In your borrowed funds. Agreed or disagreed? Please tell me that. Yes or no, students?
Agreed, sir.
Everybody
sir.
agrees to my justification?
Yes.
Yes, sir.
Okay. Okay. Please take a screenshot.
Done.
Excuse me,
Please take a
sir.
screenshot.
Excuse me, sir.
हाँ बोलना भाई.
Can you please re-explain the C option, sir?
I'm sorry.
C option, can you please re-explain it?
No. Of course, I will explain. Aditya, in the future,
Yes,
you
sir.
need money.
Yes, sir.
And you are going to raise that money by issuing a bond.
Okay, sir.
Is a bond a borrowing or an equity? It's a borrowing. Correct?
Yes, sir. Yes, sir.
What will increase for you, beta? Borrowing will increase.
Yes, sir.
The borrowing will increase. The financial risk will increase.
Increase.
If the financial risk is increasing, the financial leverage will also increase.
Yes, sir.
How do I raise money by the bond? I issue the bond. Bond is a liability. Liability will have credit balance. Debit what comes in? Cash bank account debit to bond account. Agreed?
Agree.
100%?
Yes, sir.
देखा? नहीं समझा तो बोल.
No, sir, I understood.
You understood D?
Yes, sir. D, I understood.
Super. Rajita, screenshot taken.
Yes, sir.
Rub करूँ?
Yes, sir.
Which question? This question. What is the answer? C. अरे correct आया. Fluke. Got it, guys? Got it? So question
Yes, sir.
number 45 is over. Now which one? Question number 44. The purchase of a treasury stock. This is again a conceptually important question. These are two. Acha, by the way, 45 also are marked by this. No? This is an important question. Huh? 45 was important. Purchase of treasury stock. Now please understand what is the meaning of treasury stock. Treasury stock in simple word means buyback of shares. It means what? It means buyback of shares. My dear students, what will happen in buyback of shares? In buyback of shares, what essentially happens is, equity which is issued is repurchased by the company. Simply speaking, equity has the impact of cancellation and cash goes out. What happens? Cash goes out. Also, in your capital structure, what will happen? Your equity will fall due to buyback and your debt will be unchanged. Do you all agree with this statement? Please tell me that. Conceptually, I discussed it. You are doing a buyback of shares, your equity will reduce, you have to pay the money, your cash is going out, your equity, your, what is that called? Your capital structure, your equity falls and your debt stays the way it is. Yes or no, you tell me that.
Yes, sir.
Agreed? Everybody agrees?
Yes. Yes.
Treasury bill will not be deducted in equity. Treasury bill is a deduction of equity. It means you can say deducted in equity however you want to put. Right? Understood? Okay. Now.
Sir,
Surplus cash
buyback
was
से
there, more money
कंपनी
was
का
there.
इक्विटी
Yes.
बायबैक से कंपनी का इक्विटी कम कैसे होता है? ओनर अपना खुद ले
Yes.
लेता है ना?
नहीं. Buyback में क्या होता है? चल, I'll explain you. We'll talk about Apex. Okay? Today Apex has 5 shareholders. How many shareholders?
5.
Pushkar. How many shares? 50,000. Monica, how many shares? 10,000. Aditya, how many shares? 10,000. Rachita, how many shares? 10,000. Divya, how many shares? 10,000. 1, 2, 3, 4. Now fifth one. Fifth one, Maruf. How many shares? 10,000. Total how many shares?
1.
Pushkar wants more control. He proposes to Monica and Rachita and Aditya. Give me your shares at a premium. At a premium. They say okay. Journal entry. Equity share capital is cancelled. I took their shares back from them. I gave them cash. And you said it is at a premium. So I will debit premium on buyback. I will debit what? Premium on buyback. But I'm not confusing you by that. What happened because of this essentially? Monica, Aditya, and Rachita, the shares are cancelled. Now look at the new structure. Pushkar has how many shares? Look at the new structures. Pushkar has how many shares? 50,000. Monica is gone, Aditya is gone, Rajita is gone. Who is left? Divya is left with 10,000 shares. And Maruf is left with 10,000 shares. Now how many shares are there? 70,000. Earlier, how much was Pushkar holding in the company? 50%, 10%, 10%, 10%, 10%, 10%. What did I do by this? I did this as 10 divided by 70 percentage. I made their share 14% and 14% respectively. And Pushkar's share in himself became how much? 50 divided by 70 percentage, which is how much? 71%. Automatically, Pushkar now controls the company by buying out Monica, Aditya, and Rachita. Earlier, Pushkar could not control the company. He had 50%. He needed that 1% extra. Pushkar said nothing doing. Full risk. उठा 20% और मेरे को मेरा कंपनी चाहिए. Are you understanding what I'm trying to say? There are 5 shareholders. Who are they? These ones. Did you understand buyback?
Yes, sir.
And where did
इक्विटी नहीं
Pushkar
बढ़ता है.
and
I
where did
thought कि
Pushkar get this money
30,000
from? Wait. Where did Pushkar get this money from?
cash.
सर पड़ा हुआ था, सरप्लस था. It was lying idle. दे दिया. Got it?
Yes, sir.
हाँ.
तो
Now your doubt.
30,000
Now ask
shares
me.
नहीं बढ़ते.
नहीं, कैश बढ़ता नहीं, उल्टा कैश कम होता है.
Shares.
बायबैक में क्या होता है? एक मिनट. बायबैक में क्या होता है? इक्विटी शेयर कैपिटल कम होता है और कैश भी कम होता है. पर प्रमोटर को क्या मिलता है? इंक्रीज होता है. देखना, 50% से मैं कितने पे बैठ गया? 71 पे बैठ गया ना. मेरा कंट्रोल बढ़ गया है कि नहीं? बात में तो
Yes, sir.
हाँ. तू भी खुश, तेरे को प्रीमियम मिला. तो बोलेगी
Yes,
सारा
sir.
एपेक डूब जाएगा, मेरे को नहीं चाहिए, मैं लेके जा रही हूँ प्रीमियम. आर यू अंडरस्टैंडिंग? यस और
Yes,
नो?
sir. Yes,
Sir,
sir.
like this, it happens in the real world. I will read out a particular passage for you. Please understand. I will read out a passage for you. I need your patience for that. Just allow me. I'll read out a passage. Yes. The graffiti artist. The book name is 0 to 1. The graffiti artist who painted Facebook's office walls in 2005 got stock that turned out to be worth $200 million. वो थे ना दीवार पेंटिंग करने वाले आर्टिस्ट लोग, उसको मार्क जकरबर्ग के पास पैसा नहीं था देने के लिए, उसने क्या दिया उसको स्टॉक, उसने वो बेच दिया मार्केट में, उसको कितना पैसा मिला $200 मिलियन, वापस हाथ में पेंट ब्रश लिया ही नहीं रहेगा उसने. While a talented engineer who joined in 210, who also got stock, might have made only $2 million. It is impossible to perfect fairness when distributing ownerships. Founders will do well to keep these details a secret. This is about, I'm doing some studies. I think I'm reading enough books today to say that now I'm doing an MBA on my own, self-taught kind of an MBA I'm doing now. So I'm reading now, this made sense to you. What
Yes, sir.
happened? Equity. I bought you out.
Yes, sir.
So what happened over here? Is there an increase in the firm's asset? No. The cash is reducing. Increase in the firm's financial leverage? Yes. As equity is reducing and debt is unchanged.
Excuse me, sir.
1 second. Increases the firm's equity? No. Buyback? 1 second, I'll answer your doubt. Buyback reduces capital. Increases the firm's interest coverage ratio? No. No, not connected. Yes, Danish, your doubt, please.
Yes, sir. The question says that Pushkar purchases the treasury stock with the help of surplus cash, right? Firm
Correct.
surplus. How can he use the firm surplus cash
Of
to
course,
buy?
he can pass a board resolution of all the directors for
Okay.
doing a buyback. Buyback is allowed legally under all companies acts everywhere, such that you are not buying back more than 25% of the firm's equity. You have to
Okay.
transfer a certain amount of free reserves to a redemption reserve. After that, you have to do the basic accounting and you can do it. Buybacks are a regular feature of business. Dhirubhai
Okay.
Ambani used to do a buyback when he felt that his control is going. L&T
Hmm.
did a buyback when Anil Naik felt that Dhirubhai is trying to take over L&T. So many
Mhm.
people have done buybacks to keep their control in their hands. It's a normal feature of business. It's a
Okay.
very normal feature of business. It is called as a white knight strategy. A white knight strategy means when somebody is trying to pick up my crown jewels by buying me out, I will only buy that person's equity out and throw him out of the boardroom. It's a very common feature in America, which is a far more ruthless corporate culture compared to India.
सर इट इज लाइक जिसके पास ज्यादा कंट्रोल है वो और ज्यादा कंट्रोल ले सकता है.
It is not like that. It is
Okay.
that.
Okay, okay.
It is that. It is a tool. Buyback is a tool for promoter to ensure his grip over the business.
Thank you, sir.
So what is your answer? What is your answer for 45? This is about 44. I beg pardon. What is your answer for 44? It increases. Yes. So that's your answer. Understanding?
सर ट्रेजरी स्टॉक मतलब बायबैक, ट्रेजरी बिल्स
ट्रेजरी स्टॉक
रहेगा तो
मतलब
शॉर्ट टर्म.
अपन क्या बोलते हैं इंडिया में? इक्विटी शेयर्स बॉट बैक. बराबर है? अपन इंडिया में क्या बोलते हैं? इंडियन टर्मिनोलॉजी, इक्विटी शेयर कैपिटल बॉट बैक. यूएसए में क्या बोलते हैं इसको? ट्रेजरी स्टॉक. सर क्यों? ये शेयर्स अभी कंपनी के तिजोरी में पड़े रहेंगे और जब कंपनी को पैसे लगेंगे तब कंपनी क्या मारेगी? एंट्री घुमाएगी, ये शेयर्स को इशू करेगी. आई बात समझ में?
यस.
100%.
एंड ट्रेजरी बिल्स इज शॉर्ट टर्म मार्केटेबल.
Treasury bill is different. Treasury bill is something that a government issues is something that government issues as a debt instrument at a low rate of interest, but absolutely zero risk for people to invest in, and uses that money for creation of various infrastructures. Example of this in Indian terminology are Rural Electrification Corporation Limited bonds, National Highway Authority of India Limited bonds, NHAI bonds, which are used for creation of national highways, for providing electricity to rural regions, etc. You give the loan to the government gives you 2%, 3%, they take your money, use that to build the infrastructure. From that infrastructure, the funds are released to the government returns you your money with interest. You are happy, poor villager is happy, government is happy.
तो वो
Understood?
शॉर्ट टर्म मार्केटेबल सिक्योरिटी में जाएगा.
Short-term marketable security can be anything, your share of Reliance.
ट्रेजरी बिल्स भी इसमें जाएगा.
No, treasury
No.
bills, if you are the investor, yes.
Okay,
तुमने
yes.
खरीदा है तो it is marketable. Treasury bills are extremely marketable. They are the safest form of investment today क्योंकि सरकार guarantee देती है. So if you are the purchaser of the bill, means you have given the money to the government, it is your asset. If the government has issued it, government के लिए वो liability बन जाए.
Got it, sir.
Understood?
Yes, sir.
Clear? Now please
Yes.
take a screenshot of this with the terminology dialogue in it. एक second, ये कुछ तो लिखा है. If there is no surplus cash, the powerful guy having more percentage in equity can bring his own money and buy the other shares. Of course, that is what they normally do. That is what they do. Can he? Nahi, he will. He will. He will do that. That's what is business.
Done, sir. Done.
Now which question? Question number 43. This is a nice question. Good question. The following information has been derived from the financial statements of Boutwell Company. Let us see what Boutwell is saying. Boutwell says we have current assets 640, current ratio 3.2 total assets and long-term liabilities. Okay. My dear friends, sir, you did not even read the question. Arey, leave the question here. Start doing the analysis. Current ratio is equal to current assets upon current liabilities. Therefore, 3.2 is equal to current assets 6,40,000 divided by current liabilities. Current liabilities is equal to 6,40,000 divided by 3.2. 6,40,000 divided by 3.2. Your answer is current liabilities is equal to 2 lakhs. Now suddenly I can see over here total assets. Now please pay attention. Please pay attention. Please don't be distracted. Total assets are 9,90,000. Okay. Total liabilities will be long term, which are 1,30,000 plus current liabilities. कहां से मिला? यहां से मिला. How much? 2 lakhs. Can I say total liabilities are 3,30,000? Therefore, total equity. You remember the formula? Assets minus debt will be how much? 990 minus 330, which is equal to 6,60,000. First ratio. Sir, I can calculate with this debt to total assets. Sir, you are not looking at the question. I am not interested in Becker. I am interested in Apex. Debt to total assets. What is my total debt? My total debt is 3,30,000 divided by total assets 9,90,000. Sir, what is this? 3,30,000 this. So this will be 33 divided by 99. What is your answer? 0.33. Sir, the meaning of this is that 33.33% of my total assets are financed by debt. Sir, second. Sir, debt to equity. Yes. Why not? Total debt is 3,30,000. Total equity is 6,60,000. So this will be 33 divided by 66. Sir, the answer is 0.5. Means 100 रुपया जेब का लगाया तो 50 रुपया लोन लिया. Third. Sir, long-term debt to equity. Sir, long-term debt to equity. Yes. What is my long-term liabilities? 1,30,000 divided by equity. I just calculated 6,60,000. What is the answer? 13 divided by 66. What do I got? 0.196. What is the meaning of this? That long-term loans are approximately 20% of the total equity invested. Agreed or disagreed? Yes, sir. Sir, now what is Baker asking? They are asking debt to equity. Where is debt to equity? Debt to equity 0.5 is to 1. So simple. But we did so many extra questions. Are you with me on that? Yes or no?
Yes, sir.
Screenshot. Screenshot. 10 questions are left. You want a 5-10 minute break? I don't mind giving you. We can wrap up by about 11:30, 11:45 or something like that. 5 to 10 minutes. Depends. Or you want me to just kill it and then straight away stop the lecture? You decide. What do you want?
Sir, break.
You guys want a break? Just 10 questions are there. Hardly how many? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. Let's see this question. Let's see this question. 1 second. One second. Just 1 second. Let us see this question. What is this question? What they are asking in this question? They are asking you total debt ratio for the year. Total debt ratio. Total debt ratio. What is the meaning of total debt ratio? Acha, by the way, would you like to do this on your own? Would
Yes,
you
sir.
like to do this on your own? Okay, chalo.
Yes, sir, yes.
Let us do one thing. Let us do one thing. Because I am only doing it. Acha, you want it as homework? I don't mind. But I want it to be submitted by tomorrow.
Yes,
Will you
sir.
submit?
Yes, sir.
Yes.
Okay, wait. Then I'll give you the question. Then I'll give you the question. And I think now you will be in position to solve it. But you will not just do what I am saying. You will not just do what Baker is saying. I will, can you tell me the journal entry for this? Journal entry for bringing in money in the business. Debit what comes in, cash account debit, creation of capital, equity share capital. Promoter is giving loan to the business. Debit what comes in, bank account debit, creation of liability, promoter's loan. It can be anything. Depends on the source of money. Sir, please explain total debt ratio. Okay, pay attention. Total debts. They comprise of non-current liabilities and they comprise of current liabilities. Okay. This total debt you will divide with total assets and you will ask yourself what percentage of total assets are financed out of debts. Now in this case, what are your total debts? Now look over here. Huh? Now look over here in this question. In this question, what are your total debts? Let us see over here. Your total liabilities are 19 lakhs. So year 1, year 2 कौन सा क्या है जरा एक बार मैं देख लेता हूँ. ऊपर गया है ये 1 ही होगा. हाँ करेक्ट. राइट वाला 1 कहाँ गया? इधर अंडरलाइन. नाउ पे अटेंशन. ये तुम्हारा टोटल लायबिलिटीज है. कितना है ये? 19 lakhs. ओके. ईयर 2 में कितना हो गया? 21 लाख. नो प्रॉब्लम. अभी तुम्हारा मुझे चाहिए टोटल एसेट. टोटल लायबिलिटीज एंड इक्विटी मीन्स ओनली ना टोटल एसेट्स राजा. Why? Because assets is equal to liability plus equity. Balance sheet equation. तो ईयर 1 में कितना है? 33 लाख. कितना है ये? 33 लाख 35,000. और ये कितना है? 37 लाख 10,000. व्हाट इज द फॉर्मूला? ये ए है, ये बी है. ए डिवाइडेड बाय बी है. सो ए डिवाइडेड बाय बी कितना क्वेश्चन है ये? क्वेश्चन नंबर ये है 42. ए डिवाइडेड बाय बी क्या है तुम्हारा आंसर? ए डिवाइडेड बाय बी. ए डिवाइडेड बाय बी व्हाट इज योर आंसर? 19 बाय ये. इसका आंसर आया है तुम्हारा 0.5697 और इसका आंसर आएगा तुम्हारा 0.5660. बराबर है. यस बराबर है. आर यू विथ मी ऑन दैट? दानेश समझा कि नहीं समझा?
Yes, sir.
ठीक है. नाउ टोटल डेट रेशियो तो मैंने कर लिया. आई वांट यू टू डू लॉन्ग टर्म डेट टू इक्विटी इन दिस. थर्ड आई वांट यू टू डू, क्या बचा? हाँ, डेट टू इक्विटी. थर्ड आई वांट यू टू डू डेट टू इक्विटी. और आई वांट यू टू नो दैट क्वेश्चन 42 और 41 में ये सारे कवर्ड है. ये क्या है? सारे कवर्ड है. ओके. तो क्या रहेगा अभी? डेट टू इक्विटी. तुम लोग करोगे कि मैं करके दूं?
सर कर
Yeah.
लेंगे.
करेंगे सर.
करोगे? तो ये मैं दे दूं होमवर्क में?
हाँ. यस सर.
पक्का है? कर पाओगे ना? क्या कुछ नहीं है क्या? अभी करना ही पड़ेगा.
यस.
आई हैव टू जंप आउट द विंडो यार, बट आई कांट क्योंकि ग्रिल्स है. जोक. ओके. 41 42 इज ओवर. चलो स्क्रीनशॉट ले ले भाई रचित. हो गया. ये 42 हो गया. ये क्या है? डेट है ना. 42 का आंसर क्या आएगा? अब भी सॉल्व किया ना. 42 का आंसर क्या था? ये था शायद, सी था. ये था शायद सी था. यहाँ पे देखते हैं. हाँ सी था. दोनों का 5 6 सी था. ये 5 7 5 7. तो ये क्या है? ये 5 7. ये भी 5 7. ये तुम्हारा 42 हो गया. ओके. 41 वही ये डेटा है. वही डेटा है. और तुम लोग को पूछ रहा है डेट टू इक्विटी पूछा. वही डेटा है. डेट टू इक्विटी पूछा. तो ये होमवर्क हो गया. क्वेश्चन नंबर 40. 40 क्या है? ओह फैब्यूलस क्वेश्चन. दिस इज अ फैब्यूलस क्वेश्चन. चलो क्वेश्चन नंबर 40. जबरदस्त क्वेश्चन. जबरदस्त क्वेश्चन है क्वेश्चन नंबर 40. क्या बोलता है क्वेश्चन नंबर 40? इन अकॉर्डेंस विथ सैम कंपनीज लोन एग्रीमेंट विथ फर्स्ट बैंक. समझो कि एक तो लोन एग्रीमेंट है. सैम कंपनी मस्ट मेंटेन अ डेट टू इक्विटी रेशियो ऑफ 0.6 और लेस. यू आर सपोज टू मेंटेन a debt to equity ratio of 0.60 or less. What is the meaning of this? डेट है. डेट लॉन्ग टर्म डेट नहीं बोल रहे, डेट बोल रहे हैं. मतलब टोटल डेट अपॉन इक्विटी इज इक्वल टू 0.60. मतलब नॉन करंट लाइबिलिटीज प्लस करंट लाइबिलिटीज अपॉन इक्विटी कितना रहेगा तुम्हारा? 0.60 रहेगा. इसका मीनिंग क्या है? इसका मीनिंग एक ही है कि एट एनी पॉइंट इन टाइम, any point in time, the non-current liabilities and current liabilities cannot exceed 60% of the total equity. They cannot exceed 60% of the total equity. Who is saying this? Bank is saying this. Why? They are protecting themselves. अरे तुम दूसरी जगह से लोन लेते जाओगे तो ये फर्स्ट बैंक की तो वाट लग जाएगी. You will cheat this first bank. First bank is securing its own loans. Understanding everybody? Give me a thumbs up if you have understood this much of my statements. This much of my statements have you understood? Please tell me that.
Yes, sir.
Everybody understanding this much of my statements? Everybody, huh? Danish, Aditya, Preeti,
Yes sir.
Monika, Haripriya, everybody are understanding this much of my statements? Now next, now see what is happening next. At the year end, Sam Company's balance sheet includes total liabilities of 55,000. Okay. Total liabilities means non-current liabilities plus current liabilities. How much is that? $55,000. And total stockholders equity is $95,500. Sir, 1 second. Whatever the question has asked, just keep it aside. Can I say that total assets are 55,000 plus 95,500, which is 1,50,500? Does everybody agree to this statement? Yes or no? Does everybody agree to this statement? Yes or no?
Yes.
Sir, can I say that debt to equity? Sir, can I say that debt to equity is equal to 55,000 upon 95,500 which is equal to 0.5759 means 0.58. So it is less than 0.60. Therefore, Sam has met first bank's condition. Agreed or disagreed? Please tell me that. Sam has met first bank's condition. What was first bank's condition? It has to be 0.6 or less. Correct? Yes or no? What is this? This is first bank's
Yes.
condition. Now go ahead. Now see what is ahead. Debt to equity. Now I'm just saying one more thing. Debt to assets. Sir, why you are doing like this? Just because I can calculate. You should get the practice. What will it be? Total liabilities divided by total assets. What is your answer? 55,000 divided by 150,500. What I got? 0.3654. Means 36.54% of Sam's assets are debt financed. Means financed out of debt. So both the debt to equity and debt to asset is below 0.6. Now let us see. Sam company's debt to equity ratio at the year end is 0.37. Wrong. The debt to total assets is, and it has satisfied the bank's covenant. This is wrong. Sam company's debt to equity ratio at year ending is 0.58. Correct. And it has satisfied the bank's covenant. This is the right answer. Sam's is 0.63 is wrong, and it has not satisfied is wrong. Sam company's debt to 1.74. Bullshit. It is not satisfied. Wrong. What is your answer? Is 0.58 and he has satisfied the bank's covenants. Agreed or disagreed, everybody? Agreed or disagreed?
Agreed, sir.
Agreed? Everybody understands the question? Yes or no?
Yes.
Yes? Yes? Chalo, take a screenshot. Take a screenshot. Taken?
Yes, sir.
41 was homework, 40 is over. 39. Which of the following is the best indicator of long-term debt paying ability? My dear friends, long-term debt, is it solvency or liquidity? It is solvency.
Solvent.
Working capital turnover, liquidity, asset turnover, current ratio, debt to total asset ratio. Asset turnover is assets and turnover, which is sale. We have not yet discussed it. Current ratio is liquidity. What is your answer? Debt to total assets. What is your answer? Debt to total assets. Are you with me on that? Yes or no? Please tell me that.
Yes, sir.
Yes or no? So question number 39. What is your answer? Option number D. What is your answer? Option number D. Please take a screenshot. Taken?
Yes, sir.
Question number 38. What is question number 38? Accountant has determined that last year a company has earnings before tax of 7,50,000 and interest expense of 125. What is this? EBT. Okay, 625 is EBT. Income tax of 40%. What was the company's degree of financial leverage last year? Arre, what is financial leverage? Yeah. What is the answer? 7,50,000 divided by 6,25,000. 1.2 finished. Simple. Screenshot. Screenshot.
And
Question number 37. Which of the following statements is true for both operating leverage and financial leverage? Financing the firm with a high percentage of common stock means equity Relative to debt is a technique used to achieve both financial. No. If equity is greater than debt, financial leverage is less. Agreed or disagreed to my statement? Yes or no? Please tell me that.
Yes, sir.
Investors and firms both use leverage as an attempt to increase profit, although there is no guarantee that this will happen. True. Leverage is a risk. What is the guarantee? That there will be return. What is the guarantee? There is no guarantee. What is your answer for question number 37? It is B. Using a high degree of both kind of leverage is an excellent way to minimize risk. एक मंगा मोमबत्ती लगा दे मेरे माथे पे और केक समझ के मेरी गर्दन काटता है. 2 3 4 घंटे से चिल्ला रहा हूं. लीवरेज इज अ वे ऑफ मैक्सिमाइजिंग रिस्क. तुम लोग बोल रहे हो मिनिमाइजिंग रिस्क. व्हाट रबिश. Increasing variable operating expenses results in high leverage. Mad or what? Increasing variable operating, it lowers the degree of risk. It lowers the degree of risk. What is your answer? Option number B. Are you with me on that? Yes or no?
Yes, sir.
Yes or no? Take a screenshot. Take a
Yeah.
screenshot. Question number 36. The use of debt in a capital structure of a firm increases financial leverage. Yes. Increases operational leverage. No, it is financial in nature. Decreases financial leverage. What rubbish. Debt will increase financial leverage. Decreases operational leverage, not related. But statement is wrong. But statement is wrong. It increases the financial leverage. Take a screenshot. Take a screenshot. Yes or no?
Yes.
Question number 35. Firms with a high degree of financial leverage, what will they experience? A low percentage of fixed financing cost? No. There is a high degree of financial leverage. Therefore, borrowed funds are high. Therefore, interest is high. So this is wrong. Once the fixed interest costs are covered, EBIT will go straight to net income. Yes. What is the meaning of this? याद है मैंने लिखा था. There are two people who will eat, outsiders and owners, and there will
Yes,
be
sir.
one person who will eat. ये वही है. Once you pay lenders, all money belongs to whom? Belongs to owners. EBIT माइनस इंटरेस्ट क्या बचा? EBT. ये पैसे पे तुम लोग टैक्स काटोगे और ये क्या बचेगा? EAT. ये EAT किसके पास जाएगा? ये प्रेफरेंस शेयर होल्डर्स और इक्विटी शेयर होल्डर्स को ही तो मिलेगा ना. Yes or no? Are you with me on that?
Yes, sir.
Agreed?
Yes, sir.
Yes, sir.
It must produce sufficient sales revenue to fixed operating cost. My dear friends, high degree of financial leverage. So here we are not dealing with operating cost. But dealing with fixed finance cost. Decisions regarding financial leverage are often a result of industry characteristics. No. Financial leverage are taken by management. It is an internal call. It is an internal call by CFO, accounts controller, and team. It has nothing to do with industry. Yes, they will follow industry trends. They will follow trends. But they can redefine also. But they can redefine everything. They can redefine the trends. Are you with me on that? What is the trend of the CMA cheater people industry? Not to do MCQs. get some Anguta chap professor who just talks to you and goes away. We are redefining the trend. Why? We want to do business differently. Similarly, there is some company who wants to do business differently. It will do something different. Are you understanding what I'm trying to say? So once the interest costs are covered, EBIT will go to net income. Are you with me on that? Yes or no?
Yes.
Take
Yes,
a
sir.
screenshot. Take a screenshot.
Yes.
Taken?
Yes, sir.
31. A firm that designs its cost structure to include a higher degree of operating fixed cost than variable cost by electing to pay salary instead of commission. See, commission is variable, but salary is fixed. Both commission and salary, what are they? They are operating cost. And now your operating costs are fixed in nature. So what are you increasing? You are increasing your dual. They are using the concept of what? Operating leverage. Are you with me on that? Yes or no?
Yes, sir.
Everybody understands? Yes or
Yes.
no?
Sir, please repeat.
Commission is variable. Salary is fixed. Instead of paying my salesman a commission, I am paying him a salary, means a fixed cost I am incurring. This cost is fixed. And this cost is related to operations. Why? Because it is salary. Where the cost is fixed and this cost is related to operations, it is related to degree of operating leverage. Where it is related to finance, it is related to degree of financial leverage. Here you are taking what? Fixed operational cost, therefore you are working on operational leverage. Yes or no?
Yes, sir.
Understood?
Yes.
Rajita, take a screenshot of this. This chart is good. Taken?
Yes.
32. Firms with high degrees of financial leverage. I just gave you a chart for this. High degree of financial leverage will have a high debt to equity ratio. Zero coupon bonds means no interest. Zero coupon. What is the meaning of the term coupon? Coupon means interest. If there is zero interest, means there is no risk. There is no impact on degree of financial leverage. Low current ratio. Current asset upon current liabilities. Suppose this is low. That means current liabilities are less than or equal to current assets are less than or equal to current liabilities. But current liabilities do not impact leverage. Yes or no? At the very beginning of this lecture, I have written in a note that current liabilities impact operations and they don't impact leverage. When
Yes,
Rachita
sir.
will send you the screenshots of today, you will find that I have specifically written. You
Yes,
want to
sir.
see it? Yes or no? You want to
Yes.
see?
No, sir, we have it.
It is there. It is written, specifically written, right? Specifically written in the notes. High fixed charge coverage. What is the meaning of high fixed charge coverage? EBIT upon interest is high. That means EBIT covers interest multiple times. How many times? Multiple times. Degree of financial leverage. So if this happens, degree of financial leverage automatically will go down. Why? Because risk related to interest payment has reduced. Keep that much in mind. Are you with me on that? Yes or no? Are you with me on that?
Yes. Yes, sir.
Yes. So if there is a high debt to equity ratio, means debt upon equity is high. Therefore, obviously debt is greater than or equal to, debt can be greater than or equal to, means debt is a large number. For this, refer to chart or table on leverage and ratios. Remember in that MCQ side में वो मैंने लिखा था वो table. Rachita, what is that question number? Can you see in your laptop and tell me? Can you see, please?
It was earlier question, no, sir, 31.
What was the question number?
31.
क्वेश्चन 31 था. You sure? Are you sure? See the screenshot. No?
Cost fixed financial and operating वही वाला ना सर?
अरे वो एक स्क्रीनशॉट है, देखो ना, मैंने उधर साइड में ऐसा लिखा है, रेशो, डिग्री, इम्पैक्ट ऑन लीवरेज. देखो ना, एक स्क्रीनशॉट है. कौन सा क्वेश्चन नंबर है वो? मिला क्या?
नहीं सर, looking.
ठीक है, नो प्रॉब्लम. देयर इज अ प्रीवियस क्वेश्चन, यू ऑल रिमेंबर ना, ड्रॉन दैट चार्ट.
Yes, sir.
रेफर टेबल इन प्रीवियस क्वेश्चन. What is your answer over here? The answer is A. The answer is A for 32. Okay, guys? The answer is A. Let's just take a screenshot of this.
45. Question number 45.
Question number 45. Now, please take a screenshot of this. Taken? Taken?
Done, sir.
32. 33. A firm with a high degree of operating leverage when compared to industry average implies that. Understand one thing. There is a firm and there is industry. The firm has high degree of operating leverage. What is the meaning of this? This firm incurs higher fixed operating cost compared to industry. Industry incurs lower fixed operating cost compared to firm. Firm has higher variable cost. No. Firm's profits are more sensitive to changes. Yes. Why? Do you remember? Do you remember that when you take into consideration Dual has two formulae. First is contribution upon EBIT. What is the second formula of Dual, please? What is the second formula of Dual, guys? Do you remember the second formula of Dual? It is percentage delta
Percentage into.
EBIT upon percentage delta sale. Therefore, it is more sensitive to changes in sales volume. Means what? If sales will change a little bit, EBIT will change more. Yes or no?
Yes.
That is why this is your answer. Firm is more profitable, not necessary. The firm is a significant amount of debt financing. This is degree of financial leverage if it is using debt financing, not degree of operating leverage. So this is not your answer. This is not your answer. What is your answer? Your answer is option number B. Take a screenshot, please. Take a screenshot.
Done, sir.
Done. This is your answer right here. Okay. Last question of the day. Last question of the day. So rather interesting question. Actually, kuch nahi hai. They have just confused you. They have just confused you in this question. All this is rubbish. Huh? All this is rubbish. See, what are they saying? Company sells 400,000 bottles of perfume each year. Each bottle costs 84 to produce. This is cost of production assumed to be variable cost. And it sells for $1. Selling price 1. Variable cost 0.84. What is the contribution? 0.16. Of course, this is per unit. How many units? 4 lakhs. Correct? So 4 lakhs into 0.16. 64,000. What is this? Contribution. Fixed cost. What is your fixed cost? 28,000. EBIT. 64 minus 28. What is your answer? 36,000. Keep this much in mind. What are they asking? Degree of operating leverage. Itna karke operating. What is operating leverage? Contribution upon EBIT. 64,000 divided by 36,000. 64 divided by 36. What is the answer? 1.78. What is the answer? 1.78. Let's see if I am wrong or right. 1.78. Absolutely correct. Absolutely correct. Please take a screenshot. Please take a screenshot. Taken?
Yes.
So as committed, all the MCQs of this chapter have been completed.